Welcome to today's class on transfer pricing, a foundational concept in cost accounting. Imagine a company with multiple divisions. How do they set prices when selling goods or services to each other? That's where transfer pricing comes in. We'll explore what transfer pricing is and dig into how organizations determine acceptable prices for these internal transactions. You'll see why this isn't just an accounting formality. It's a tool that shapes both management decisions and company strategy. By the end of this lesson, you'll not only understand the theory, but also how transfer pricing impacts real businesses through detailed examples. Let's dive in and see why mastering transfer pricing is essential for every aspiring accountant. To truly grasp transfer pricing, we first need to understand the backbone of organizational control: management control systems. Think of these systems as the central nervous system of a business. They gather and use information to coordinate planning, make control decisions, and guide how managers and employees behave. Why does this matter for transfer pricing? Because the way information flows and decisions are coordinated directly influences how divisions interact and negotiate prices. Whether it's setting sales targets or evaluating performance, a robust management control system ensures everyone's actions align with the organization's broader objectives, laying the groundwork for effective transfer pricing policies. Management control systems come in two forms: formal and informal. Formal systems are like the rulebook of an organization. They spell out explicit rules, procedures, performance measures, and incentive plans that shape manager and employee behavior. Within these formal systems, several subsystems play key roles. Management accounting systems track costs, revenues, and profits. Human resources systems handle recruitment, training, and even monitor absenteeism, while quality systems focus on product yields and delivery reliability. Each subsystem generates data crucial for making informed decisions, including those about transfer prices. Understanding these formal controls helps you see how companies create consistent standards across their divisions, ensuring fair and strategic transfer pricing. While formal rules set the framework, informal management control systems shape the everyday culture of an organization. These include shared values, loyalties, and unwritten norms. Think of them as the invisible threads holding a company together. For example, a powerful slogan like Ford's "Quality is Job One" isn't just marketing. It reinforces loyalty and sets expectations about behavior and performance. In the context of transfer pricing, such informal controls can influence how divisions cooperate or compete when setting prices. A strong culture can encourage goal alignment across departments, even when financial incentives alone might not be enough. For management control systems to be truly effective, they must closely align with an organization's strategies, goals, and structure. Imagine trying to motivate a soccer team without connecting their efforts to winning matches. It just wouldn't work. Similarly, control systems should support each manager's responsibilities and fit the organization's structure. For example, decentralized companies face unique challenges compared to centralized ones when designing controls for things like transfer pricing. Motivation is also key. It combines both the desire to achieve shared goals, goal congruence, and the drive to put in sustained effort. When all these elements align, managers are empowered to act in ways that benefit both their division and the overall organization. Let's break down motivation into two critical aspects: goal congruence and effort. Goal congruence occurs when everyone, individuals or teams, acts in ways that support the organization's overall objectives. In transfer pricing, this means managers set internal prices not just to benefit their own division, but to help the whole company succeed. Effort goes beyond just working hard physically. It includes mental determination and creativity needed to reach those goals. When both goal congruence and effort are present, organizations can trust their managers to make decisions that drive long-term value, especially when navigating complex issues like setting transfer prices. Now let's talk about decentralization, a key concept for understanding transfer pricing in modern organizations. Decentralization gives lower-level managers real decision-making power, letting them respond quickly to local opportunities or challenges. The greater their autonomy, the more flexible and adaptive each subunit becomes, whether that's a massive division or a small project team. But here's the catch. With increased freedom comes the need for clear guidelines on internal transactions, like setting transfer prices. Striking the right balance between autonomy and alignment ensures that every part of the organization works toward shared goals while still making smart local decisions. Imagine a growing company where decisions are no longer made solely by those at the top. As organizations expand, they often shift from centralized control to what's known as decentralization. This means that decision-making authority moves down the hierarchy, empowering supervisors and middle managers, not just top executives. Why does this matter? Decentralization lets organizations adapt quickly to changes because those closest to the issues can respond without waiting for upper-level approval. In the diagram, you see decision-making flowing from top management through middle management to supervisors, visually emphasizing this downward push. As companies grow larger and more complex, pushing decisions down becomes not only practical, but essential for efficiency and agility in today's business environment. So, what makes decentralization so attractive for many organizations? Let's break down 3 key advantages. First, decentralization allows companies to respond more rapidly to unexpected events. Think of a local manager who can act instantly when a supply issue arises, rather than waiting for approval from headquarters. Second, it taps into the specialized knowledge and skills of managers who are closer to day-to-day operations. These managers understand their unique challenges and can craft solutions tailored to their teams. Third, decentralization frees up top management from routine tasks, letting them focus on strategy and big-picture thinking. By distributing decision-making, organizations become more nimble, innovative, and resilient in facing business challenges. But decentralization isn't without its challenges. One major behavioral hurdle is achieving goal congruence, making sure that decisions made by managers of different subunits align with the organization's overall objectives. Imagine each manager focusing only on their own team's success without considering the broader impact. This can create tension and even conflict within the company. The real test is fostering a culture where everyone works toward shared goals despite having more autonomy. Achieving goal congruence requires clear communication, strong leadership, and well-designed incentives that encourage managers to think beyond their own divisions. It's a delicate balance between independence and unity. Decentralization brings several powerful benefits to an organization. For starters, it creates greater responsiveness to the needs of a subunit's customers, suppliers, and employees. Those closest to daily operations can address issues as they arise. Faster decision-making is another key advantage. When subunit managers have authority, they don't have to wait for approvals from above, speeding up responses to new opportunities or problems. Decentralization also supports management development and learning, giving managers valuable experience with decision-making. Finally, it sharpens the focus of subunit leaders while enabling top management to broaden their strategic reach. Together, these benefits help organizations remain flexible and competitive. However, decentralization isn't a perfect solution. It comes with real costs. One significant risk is suboptimal or incongruent decision-making. Sometimes, a choice that benefits one subunit may actually hurt the organization as a whole. This is often called dysfunctional decision-making. Another drawback is unhealthy competition between divisions, where teams might prioritize their own success over collaboration. Additionally, decentralization can lead to duplication of output and activities. Different subunits might unknowingly develop similar products or processes, wasting resources. Recognizing these pitfalls helps organizations design better control systems and policies that minimize costs while preserving the agility decentralization provides. How do companies weigh the trade-offs between the benefits and costs of decentralization? Top managers often analyze these factors function by function before choosing how much control to delegate. Interestingly, decisions about product mix and advertising are most often made at decentralized levels. These require quick action and detailed local knowledge. On the other hand, choices involving long-term financing usually stay centralized due to their strategic importance. Centralizing income tax strategies is especially valuable. By pooling profits and losses across subunits, organizations can optimize their overall tax position. Striking the right balance helps companies harness the advantages of decentralization while managing its risks. When it comes to multinational corporations, those operating in multiple countries, decentralization becomes even more critical. Centralizing all decisions across borders is simply impractical due to differences in time zones, regulations, and local business conditions. Decentralization empowers managers in each country to leverage their local expertise and adapt quickly to uncertainties in their environment. But there's a trade-off. International decentralization can mean less direct control from headquarters and increased risks of inconsistent practices. That's why global companies rely on robust management control systems to track performance across divisions. Ultimately, successful multinationals balance local flexibility with strong oversight. Let's start by understanding a crucial concept in management control systems: responsibility centers. Imagine your company as a collection of smaller teams, each responsible for a different part of the business. A responsibility center is just that, a segment or subunit where the manager is accountable for specific activities and results. To evaluate performance in both centralized and decentralized organizations, companies use four main types of responsibility centers: cost centers, which focus on controlling expenses; revenue centers, which emphasize generating sales; profit centers, which balance revenues and costs to measure profitability; and investment centers, which consider profits in relation to assets used. Knowing these categories helps clarify how companies structure accountability and performance measurement. Now let's dive into transfer pricing, a core topic in cost accounting. Think of transfer prices as the internal prices one division charges another within the same company when supplying goods or services. Why do these internal prices matter? They're not just numbers. They directly influence decision-making and how we evaluate each division's performance. For example, if the battery division sells batteries to the auto division, the transfer price set determines both divisions' reported profits. Ultimately, these prices help managers make informed choices about production, sourcing, and even investments, all while aligning with the broader goals of the company. How do companies actually determine a fair transfer price? It starts with three essential steps. First, what's the lowest price the selling division can accept and still be as well off as selling externally? This ensures the seller isn't disadvantaged by dealing internally. Second, will the buying division pay that price? If it's higher than what they could get from outside suppliers, or if it squeezes their profits, the deal might not make sense. Third, does this arrangement benefit the company as a whole? That's goal congruence, making sure divisional decisions align with enterprise-wide objectives. These steps help avoid internal conflicts and ensure everyone is working toward shared success. Transfer pricing isn't just a technical calculation, it's deeply political within organizations. Setting the transfer price affects not only the profits of both selling and buying divisions, but also the interests of their managers. Why? Because managers are often evaluated and even compensated based on their division's reported performance. As a result, each manager may push for a transfer price that favors their own division. But there's more at stake. These prices can influence major decisions like investment, production, and purchasing, potentially impacting overall company profits. Understanding these dynamics is key to designing effective management control systems. When evaluating transfer prices, it's essential to recognize that not all pricing methods are created equal. Some can drive a company toward its goals, while others may create internal conflict or inefficiency. To help a company achieve its objectives, transfer prices should meet four key criteria. First, they must promote goal congruence, ensuring that division managers, even when acting in their own best interests, are still making decisions that align with the broader objectives of top management. This alignment is crucial for the overall health and direction of the organization. Second, effective transfer prices should motivate managers to exert a high level of effort, encouraging them to optimize operations, control costs, and seek out opportunities for improvement. Third, transfer prices play a vital role in helping top managers evaluate the performance of individual subunits. By providing a fair and consistent basis for comparison, they allow for more accurate assessments of which divisions are excelling and which may need additional support or oversight. Finally, transfer prices should preserve the autonomy of subunits, especially in organizations that value decentralization. This autonomy empowers managers to make decisions that best suit their local conditions, fostering innovation and responsiveness. Balancing these four criteria is key to designing transfer pricing systems that support both healthy competition and collaboration across the company, ultimately driving long-term success. Let's explore a detailed example to see how transfer pricing can impact divisional performance and the overall company. Imagine a company with two divisions, the battery division and the auto division. The battery division manufactures batteries and supplies them to the auto division, which uses them to assemble vehicles. Now, if the transfer price for batteries is set higher, the battery division will report greater profits because it's selling its product at a premium to its sister division. However, this same higher transfer price means the auto division's costs increase, leading to lower reported profits for that division. This internal pricing tug-of-war is more than just a numbers game. It directly affects how each division is evaluated and how managers are incentivized. For instance, if managers' bonuses are tied to divisional profits, both sides will negotiate fiercely for a transfer price that benefits their own results. This dynamic can influence not only short-term financial outcomes, but also strategic decisions, such as whether to source batteries internally or externally, invest in new technology, or even restructure operations. Ultimately, the way transfer prices are set shapes managerial behavior, impacts resource allocation, and can drive or hinder the company's overall performance. Understanding these effects is crucial for designing transfer pricing policies that support both divisional and enterprise-wide goals. To wrap up our discussion on transfer pricing, let's focus on the four main objectives that guide how these prices are set within organizations. First and foremost, transfer prices should promote goal congruence. This means setting prices so that managers act in the best interest of the entire firm, not just their own division. When goal congruence is achieved, the company as a whole benefits from coordinated decision-making and minimized dysfunctional behavior. Second, transfer prices must be useful for evaluating divisional performance. By providing a clear and consistent benchmark, they allow top management to assess how well each division is operating, identify areas for improvement, and reward high performers. Third, transfer prices should motivate both sellers and buyers within the company. Sellers are encouraged to keep costs down, while buyers are incentivized to use resources efficiently. This dual motivation drives operational excellence. Finally, in decentralized organizations, transfer prices should allow subunit managers a degree of decision-making autonomy. This autonomy fosters innovation, agility, and responsiveness to local market conditions. By keeping these objectives in mind, companies can design transfer pricing systems that not only support individual and divisional success, but also drive the organization toward its long-term strategic goals. Effective transfer pricing is a cornerstone of sound management control systems. When setting transfer prices between divisions, two key factors come into play: the opportunity cost for the seller and the opportunity cost for the buyer. For the selling division, opportunity cost means considering what profit is sacrificed by transferring goods internally instead of selling them on the open market, especially if they're already operating at capacity. For the buying division, it's about what profit might be lost by sourcing internally rather than shopping around for better deals in a competitive market. That's why, in practice, we focus on establishing a reasonable range of prices that make sense for both sides. However, keep in mind, when financial statements are consolidated, these internal transfers get eliminated, so this pricing becomes irrelevant at the group level. So how do we actually set a transfer price? The general rule is straightforward. The transfer price should equal the additional outlay cost per unit. Think of this as the direct variable cost, plus any opportunity cost to the organization from making the transfer. Imagine this like a relay race. One division hands off value to another, just as runners pass a baton. If there's no sacrifice or lost profit, only outlay cost matters. But if selling internally means missing out on higher profits elsewhere, that's an opportunity cost we can't ignore. This formula ensures both divisions' interests are aligned and helps management make decisions that benefit the whole organization, not just individual parts. Let's dive into a real scenario. The battery division makes standard 12-volt batteries, and has a production capacity of 300,000 units. They're currently selling every single battery to external customers at $40 each. Now, the auto division wants to use 100,000 of these batteries in its X7 model. Variable costs are $18 per battery, with fixed costs of $7 per unit at full capacity. Here's the big question. Since all batteries are already sold externally, what should the transfer price be for those needed by the auto division? This scenario is classic, no excess capacity, so any internal transfer means giving up profitable external sales. Let's see how we calculate an appropriate price. Here's how we determine the transfer price when there's no excess capacity. Start with the variable cost per battery, $18. Next, add the opportunity cost, which is the contribution margin lost by not selling those batteries externally. Since each battery could have been sold for $40 and variable costs are $18, the lost contribution is $22 per battery. So transfer price equals $18 plus $22, totaling $40 per battery. This matches exactly what outside customers pay, ensuring neither division is unfairly advantaged or disadvantaged. It's a clear example of applying both outlay and opportunity costs to align divisional incentives with company-wide profitability. Let's explore how decision-making shifts based on external pricing options. If the auto division can buy batteries from an outside supplier for less than $40, it makes sense to purchase externally. No internal transfer happens because it's simply cheaper. But if outside suppliers charge more than $40 per battery, transferring internally becomes the better choice. The $40 threshold acts as a decision point. Below it, buy outside. Above it, transfer within the company. This approach ensures resources flow where they create the most value, preventing either division from losing out on potential profit or incurring unnecessary costs. Let's take a closer look at a fundamental rule in transfer pricing, especially when a division is operating at full capacity and there's no excess capacity available. In this situation, the general rule is that the transfer price should be set at the market price. But why is this so important? When the selling division is already producing at its maximum output, every unit transferred internally to another division means sacrificing a sale to an external customer. If the internal transfer price were set below the market price, the selling division would lose out on potential profits, which could create tension between divisions and undermine overall company performance. By pegging the transfer price to the market price, both the selling and buying divisions are treated fairly. Neither is unfairly advantaged or disadvantaged. This approach also encourages each division to operate efficiently and make decisions that are in the best interest of the entire organization. Ultimately, using the market price as the transfer price in full capacity scenarios aligns divisional incentives with the company's broader strategic goals, supports effective management control, and helps ensure that resources are allocated where they generate the most value. Now let's consider scenario 2. What happens when there's excess capacity? The battery division still makes standard batteries with a production capacity of 300,000 units, but is only selling 150,000 externally at $40 each. The auto division needs 100,000 batteries for its X7 model and could buy them from an outside supplier for just $38 each. Variable costs remain at $18 per battery. In this case, since there's unused production capacity, determining an appropriate transfer price involves different logic. Should it match market prices or reflect only internal costs? Let's analyze what makes sense when external demand isn't fully absorbing production. Let's explore how transfer pricing works when a division has excess capacity, a scenario that often sparks debate in cost accounting. In this case, the transfer price is calculated as the sum of any additional outlay cost per unit and the opportunity cost to the organization. For our example, imagine the variable cost to produce a battery is $18, and because there's no lost external sales or alternative use, the opportunity cost is $0. That means the transfer price equals just the variable cost, $18 per battery. Why is this important? It ensures that internal transfers don't penalize the supplying division or inflate costs for the receiving division. Understanding this formula lays a foundation for analyzing more complex transfer pricing situations. So, What's the general rule when a selling division has excess capacity? The answer is straightforward. The minimum transfer price should be set at the variable cost per unit. In our previous example, that's $18, but why not set it lower or higher? If you go below $18, the selling division would lose money on each unit. If you go much higher, up to $38 in this scenario, you risk making internal transfers unattractive compared to external purchases. The key takeaway, with excess capacity, the transfer price should fall between these two boundaries, no less than $18 and no more than $38. This range creates room for negotiation while protecting both divisions' interests and aligning with company strategy. Let's visualize these boundaries. Imagine a line with three zones, on the left at $18 and on the right at $38. Transfers only make sense within this central range. If the transfer price is set below $18 or above $38, it's simply not beneficial for one of the divisions. That's why you'll see transfer will not occur highlighted in red outside those points, and transfer will occur in green right in the middle. This diagram brings home a crucial point. Setting the right transfer price isn't just a technical calculation. It's about making sure both divisions are motivated to participate, maximizing value for the entire organization. Now, let's see how transfer pricing decisions ripple through a real business example. Meet Hagerty Fan, which has two divisions, Blade and Assembly. The Blade division sells all its output externally at $4 per blade, while Assembly sells fans, each requiring a blade, for $195, sourcing blades from outside at $4 apiece. Both divisions are running at full capacity. But next year, Blade faces a challenge. Losing a key customer drops its external demand by over half, from 225,000 to 100,000 blades. This change introduces excess capacity, setting the stage for internal transfers. How do these pricing decisions affect profit allocation between divisions? Let's break it down. Given Blade Division's new excess capacity, what might Hagerty Fan's income statement look like next year? Here's one scenario. Blade sells 100,000 blades externally at $4 each and transfers another 120,000 blades internally at its variable cost of $2.50 per blade, just enough to cover production expenses. The income statement breaks down sales, variable costs, other costs, and contribution margin for both divisions and as a whole. Notice how Blade's sales drop but Assembly benefits from lower costs. The consolidated contribution margin remains strong at $10,150. This demonstrates how transfer pricing can help optimize overall profitability even when one division faces a downturn. What if Blade sets its internal transfer price at $4 instead of just covering costs? Now, Blade sells both externally and internally at $4 per blade. Assembly pays more for internal blades just as much as they'd pay an outside supplier, so their variable costs increase. Blade's revenue rises to $880,000 while Assembly's costs climb, yet when you add up both divisions' numbers, the consolidated income remains unchanged at $10,150. This scenario highlights how changing transfer prices doesn't affect total company profit, but does shift profit allocation between divisions, a key concept in management control systems. Let's compare both scenarios side by side. When Blade insists on a $4 transfer price, it claims a larger share of profit, $330,000 contribution margin, while Assembly receives less. If Blade agrees to transfer at its variable cost of $2.50, Assembly's contribution margin rises, but Blade's drops to $150,000. What's fascinating is that corporate consolidated profit stays the same, only the distribution changes. This reveals how transfer pricing is as much about negotiation and divisional incentives as it is about economics. The acceptable transfer price range sits between $2.50 and $4, mirroring Assembly's current external purchase price, so any deal struck within this window keeps everyone aligned with company goals. Let's dive into a real-world example to see transfer pricing in action. Imagine Bedtime Bedding Company, where the cover division produces pillow covers and the Assembly division creates the finished pillows. The cover division can sell its covers externally for $5 each, while completed pillows fetch $6 each. Here's the financial breakdown. The cover division has manufacturing costs of $6 million and external sales of $4 million. Additionally, it transfers covers to Assembly at a market value totaling $6 million. The Assembly division then sells pillows for $7.2 million, incurring an extra $1.5 million in manufacturing costs. Your challenge: calculate operating income for each division and for the company as a whole using market value as the transfer price. But here's the twist: will every manager be happy with this arrangement? Let's explore why that might not be the case. Now let's analyze the results. When we crunch the numbers, the Cover division reports an operating income of $4 million, while the Assembly division actually shows a loss of $300,000, even though the company as a whole earns a healthy $3.7 million. No wonder the Assembly manager is unhappy. With market value used as the transfer price, Assembly feels squeezed. Paying what they would on the open market leaves little room for profit. But from a company-wide perspective, using market prices is fair, especially in competitive markets. If Assembly wants to turn a profit, they'll need to either raise their selling price or find ways to cut costs. This tension highlights how transfer pricing directly impacts divisional motivation and overall organizational performance.